Starbucks has closed 2,000. McDonald's this morning said they closed several hundred, but still have 3,000 open in China. How do you compare the impact between the two companies?
McDonald's is a headline risk. It's an entirely franchised system, and so it has less of an impact on the actual financial performance. Starbucks can see, double-digit operating income impact from its China stores. That being said, because the stock is off, it could actually end up creating a buying opportunity. Starbucks also has a strong digital relationship with their customers in China, and I thought most impressive was the digital transaction growth that was up 40%. I believe 10 million users that have, essentially using the rewards or having that digital relationship program. So if and, really when this rebounds, they're perfectly positioned to be having that guest and that consumer back in those Starbucks stores.
Matt, do we go along with that, that this creates more of a bargain in Starbucks than McDonald's, maybe?
Well, not really. I'm a little concerned with what Starbucks showed also in China before the virus broke out. So they did a 3% comp in China. That's down from 5% in the prior quarter. It's down on a 1 and a 2 year basis. It does reflect or bring up concern that are the competitors on the ground taking some share from them. They did 9% from delivery. It implies that they're seeing negative, the rest of the business is negative in the walk-up retail business. So I think that's a big concern for a company leaning in to do 600 stores out of their 2,000 globally coming from China.
Why is that, Matt? What was the explanation? Are the nitro and other cold beverages just not working as well in that market as they are in the U.S.?
Well, you've heard a lot about the competition. There's a local competitor there growing very fast. They are taking on delivery. Delivery is not always incremental overall to sales. It does cannibalize some of the existing store sales. And I think also you have to question the pace of growth. Almost 2 stores a day. Are they self-cannibalizing also? And then lastly, they are going into second and third tier markets that potentially the brand might not be set up yet for that evolving middle class, which they're making the long-term bet on.
All that said, Nicole, in the Americas, Starbucks comp 6, McDonald's 5-1. It was above 4-5 for all of last year, and additional comments today about how owner-operators' cash flow is at an all-time high. What is driving strength in the Americas?
Well, let's kind of also go back to Matt's comment on China. I mean, it's apples and oranges. I mean, the competitor he's not talking about, they're not reporting comps for a reason, and it is that cannibalization. The 3%, comp in China is apples and oranges. I mean, 80% of the revenue growth comes from unit growth. So I think we just need to keep that in mind. But to answer your question, it's beverage, and they're spot on in beverage, and it's definitely cold beverage specifically driving that traffic.
What about McDonald's? I wonder if it says something, Matt, about the U.S. consumer, or if just Starbucks and McDonald's are two good examples of companies that are innovating around their menus and executing well in the U.S.
That's a great point, Sarah. Certainly McDonald's has leaned in with the experience of the future. They call it EOTF. So they're spending over $2 billion, $2.4 billion to be exact in CapEx. A large portion of that is globally they're remodeling the stores. In the U.S., 70% of their footprint is now at that higher elevated store experience. And that's showing through in the comp numbers. So I think you have to invest. Same with Starbucks. They've invested in the U.S. and it's rewarding them. I think to the point, though, about China, you have to be concerned. Investors don't like to see square footage growth in the face of what can be perceived to be negative comps outside of delivery.
You guys really want to address this China thing. That's interesting. Finally, Nicole, traffic. What's it going to take to get that to go positive, which clearly it did not do, at least for McDonald's this quarter?
I think McDonald's is a tougher call on the traffic point. I mean, the competitive set, it's all about breakfast and it's all about maybe chicken, actually. Could be the year where it's really about chicken and QSR, especially if we end up having beef inflation. I would say 2 things. I mean, it's just an incredibly difficult environment. It takes value, but value not just on price point, value across every day part, across every platform. And really that can mean value in terms of a lot of food, at even a higher price point, new novel items. But I also want to say we're totally losing sight of who's not impacted. There's another large cap player that has 0 stores in China and doesn't have these issues, and that's Chipotle. And I don't think we should lose sight of that either.
Chipotle obviously has had its own tailwind to work with, at least in recent quarters. Matt and Nicole, thanks, guys. Obviously, a huge